quickly talk about the definition of GDP and some of the things that includes and doesn't include, and then we'll get into some basic calculations. So gross domestic product, total value of all final goods and services produced in the economy during a given year. So basically what we're trying to measure is production of new goods, and final means we want to not include intermediate goods. So there's lots of production that's happening as a good gets produced. So a car uses steel, so there's a purchase from the steel company. That's an intermediate good, goes into the car. So if we count the value of that car, then it includes all the intermediate goods that go into that, otherwise we'd be double counting that. So that's why we want to look at final goods. And then domestic means within the territory of that country. So it doesn't matter if it's foreign owned production, if it's occurring in that territory, within the borders of that country, then it's going to get counted as GDP. Normally the data you will see is quarterly, but it's going to be annualized. So it'll be, if it were to grow a certain percentage rate over the year, they'll usually tell you the annualized version of that. So GDP right now is the current dollar amount's about 21 trillion. That's not going to be all that meaningful unless you have put it in context. So you want to either look at some per capita numbers if you're going to compare it between countries, and really you want to be looking at the growth rates to see if, okay, is production higher, how much is it higher compared to a year ago, things like that. So this is from the Krugman textbook, and just looks at a couple different ways you might think about how GDP is calculated. So in this simple example, we just have this car being produced, or these cars, and a couple of intermediate steps here to produce it. So we have iron ore over here, we sell it to the steel company, they turn it to steel, they sell it to the car company, and so the final good is the car. So if we just counted that, and this was the only good, then that would be your GDP. So that's just total spending on final goods would just be the value of the car. You could count these intermediate steps as long as you don't double count. So if we do, this is the sum of value added. So if you look at how much value each step added, so we took this iron ore that's worth 4,200. Once we turn it into steel, it's worth 9,000 because that's what we sold it to the car company for. So if we looked at how much value was added each step along the way, then we wouldn't be double counting. And then so if we add that up, we would also get the 21.5. So same number. And you could also look at the flip side of this spending, which is that spending has to go somewhere as income. So if you look at how that spending is paid out to the factors of production, so part of it gets paid out in wages, interest payments if there's loans, rent for the building, things like that. Whatever's left over goes to the owners as profit. And so if you added up all those income sources, then you would also get the same number. Again, assuming that we're counting everything correctly. So usually we're thinking about it in terms of just spending on final goods like this, but you could calculate it these other ways and it would be equivalent. So we could split up GDP into these four components. We have consumption spending, investment spending. Now investment, remember, doesn't mean things like stocks and bonds. It means capital investment, buildings, machinery, that sort of thing usually is what we're talking about. I'll come back to that in a minute. Government purchases. So for government, keep in mind we have to be talking about production of a good or service. So if it's a transfer of money, it is not getting counted here because that's not production. Any kind of transfer is not production. But if the government is paying workers to do something, if it's producing tanks, then we consider that purchase of a good or service. So that is going to get counted. And this is just exports minus imports. So this net export term. So we want to count production within the country. So, and this production that gets exported we want to count, but if it's getting produced somewhere else and we're importing it, that's why we're subtracting it out. Now keep in mind, imports might show up in one of these other categories, and we just want to take it out over here so that we're not counting it. So it's not just that imports are subtracting from GDP, it's canceling out somewhere else that it might be showing up so that we're not counting imports as new production. So just really quickly, domestic production, mention that. Construction of housing buildings, so remember it's got to be newly produced. So if you produce a house, a building, now one thing about GDP is that residential housing gets counted as investment. So that's in your investment category. Other things, other construction of buildings probably is going to be also in that investment category as well. Inventories are also considered investment. So remember, if a company produces that car, for example, but doesn't get sold, well, then it doesn't show up as that final good, that spending on a final good. But since it was produced, we do want to count it, so it gets counted as that company investing in inventory. So it goes into inventory, and then if it gets sold the next year, we don't want to count it because we've already counted it when it was produced. So it would be counted as negative investment to pull it out of that spending. So it might show up as spending, but then we want to cancel that out as a negative inventory investment when that goods get sold. So again, we want to count it when it first gets produced. Okay, so not included. This is kind of just repeating what I said. So intermediate goods are not included. We don't want to double count that if we're counting final goods already. Anything that's used that's been produced and counted in a previous year, so lots of transactions then are not getting counted as part of GDP because we're only counting new production. Anything that's a financial asset, that's not a production of a good or service, that's just a transfer of ownership of something. So that is not counted as part of GDP. But if you were to pay a brokerage fee to make a trade or something like that, you are purchasing a service, that does get counted. And again, imports not getting counted. Okay, so let's go right into a simple calculation. So this is kind of an oversimplified way of how GDP gets calculated, but this gives you the basic idea. So we have two goods here. We got pizza, nachos, and I made this example so that prices of these two things are going up, but notice quantities are not going up. And so what we want to do is kind of separate this effect of rising prices from the actual production of goods here. And so nominal GDP, nominal just means the current dollar amount of GDP. So in 2011, just whatever the dollar amount of production is, so price times quantity of pizzas, price times quantity of nachos, add them up, you get 250. That's your nominal GDP. Do the same thing, just the current dollar amount in 2012, price times quantity, add them up, 310. So we see in nominal terms, it has gone up, but all that value that we just calculated in nominal terms, we can see that it's all due to rising prices. So what real GDP does is strip out the effect of higher prices to get a real number. So real basically is just tracking the actual production of stuff and stripping out that price change. So we're assuming here this is due to essentially overall inflation rather than something particular going on in the pizza market necessarily. There's always micro stuff going on, but we're going to be averaging this over many different types of goods, and so if we're seeing an overall price increase, then we can be confident that it's inflation. So what we do is just choose a base year. There's only 2 years here, so we're just choosing the first year as the base year, and we're just going to use prices from the base year. So it's very simple. Real GDP in 2011 is going to use 2011 quantities and base year prices, which are also 2011 prices. That's why nominal and real in the base year are always going to be the same, because we're just using the same prices and the same quantities. But once we go to a different year, we're doing 2012 quantity, base year price, 2012 quantity, base year price. So in that case, since the quantities are the same and now the prices are the same, that's why real GDP did not go up. So all of this nominal change was due to higher prices, none of it was due to higher output, so we've stripped out that price increase. Let's do another quick example. So here I have output rising and prices staying the same. So when we do our nominal calculation, we see nominals going up. It's now going up because of the higher output. Let's do the real calculation, 2011 base year. Again, nominal is going to be the same in the base year, but now 2012, new quantity, base year price, new quantity, base year price. So when we do that, we see all of the increase is real. All of this nominal change is also a real change. So all of it's due to higher output. More realistic cases where we have a mix of the two. So quantities are going up. In most years, we have some inflation, so we just want to be able to strip that out. So nominal going from 250 to 411, some of that's going to be due to the higher prices. Real is going to strip that out. So 2011, nominal 250, again new quantity, base year price. So now we get part of this nominal change is a real change, and then we can just get looking at the percentages. This went up 64, real went up 52, and once we have that, we also have a measure of inflation by using this. So once we strip out the inflation, we can kind of use that information to give us an inflation index. So that's what we'll do here. So GDP deflator is just a price index that's created from this information. And so all we're going to do is every year we're going to create this index, this GDP deflator, by taking nominal divided by real in that year, multiplied by 100. So since in the base year, nominal and real are the same, 250 over 250 times 100 gives me 100. So the base year is always going to have 100. And so if we went backwards in time and we had some inflation, the year before might be 98 or something, and so on, we can keep going back in time. It's just that 100 is now, it's going to be based around that 100 being in the base year. And then if we have inflation going forward, it's going to be something higher than 100. So next year, nominal went up to 411, real went up to 380, take the ratio, times 100, 108.2. So now it's the change in the index, the percent change in the index, that gives us a measure of the inflation rate. So according to this measure, inflation is 8.2%. So just keep in mind, if we kept going, let's say it went to 110 or something in the next year, you'd have to take percent change in those two numbers if you wanted that yearly inflation rate. So here you can just subtract it because we started from 100, but we'd have to go percent change from 108.2 to whatever the next number is to get that annual inflation rate using the GDP deflator.